I'm Colin Martin.
And I'm Lizanne Saunders.
And this is On Investing, an original podcast from Charles Schwab. Every week, we analyze what's happening in the markets and discuss how it might affect your investments.
Well, hi, Colin. So last week, we discussed the possibility or likelihood of a rate hike in the aftermath of the first Federal Open Market Committee meeting with Kevin Warsh as chair of the Fed. And I know that the rates markets have been changing their assumptions and what's been priced in terms of how quickly a rate hike or beyond or 2 or 3 would happen. So what are you thinking about as it relates to the fixed income market, maybe also the dollar, and what your latest thinking is on when the Fed might consider moving toward a tightening stance?
Yeah, it can have a lot of implications, Lizanne. Let me start with the dollar, because that's something we don't talk about as frequently as my broad Fed outlook. But it could mean if we get a rising, and we've seen the rising likelihood of a Fed rate hike, that could and should mean a stronger dollar. And that has lately. When we talk about the dollar, there's a lot of dollar currency pairs. But if we look at it in an aggregate level, and we look at something like the Bloomberg Dollar Index, it's up about 3% or so since early May. It's pretty close to its one-year highs. And that's because one of the key drivers, there's a lot of drivers of currencies, but interest rate differentials. So if we have this shift in expectations and then resulting rise in treasury yields, you see that rising interest rate differential that the U.S. offers relative to other developed market economies that can support the dollar. So we've started to see that. And there's also been some shifts, not just with the Fed, but the dynamics with other global central banks. So if we look at the European Central Bank, for example, they hiked rates earlier this month, but then doesn't seem as likely that they might necessarily continue soon with more rate hikes. It looks like they might take a more patient approach. And Christine Lagarde suggested that, maybe a forceful response wasn't necessarily warranted right now. So we had that, what was initially expected to be maybe a few hikes by the ECB might only be 1 or 2. And now with more rate hikes with the U.S. being priced in, that should lend support for the U.S. dollar. And that's important when you're considering global investments, local currency denominated investments. If you're a U.S. based investor, you can get, generally speaking, higher yields here in the U.S. And then if the dollar, stays strong or even strengthens a little bit, that could actually result in negative currency returns. So something to consider about if you're thinking about the global bond markets as an investment. Now, when we think about our broad U.S. outlook, Lizanne, it's pretty uncertain right now. We talked about this last week. Clearly, the likelihood of a rate hike has increased a lot. We are, stopping short of putting our flag in the sand and saying, yes, a rate hike is going to come, at this time, but we acknowledge that the likelihood is rising. I just think there's a lot of moving parts right now. We got this hawkish Fed meeting in an environment where the peak in inflation could be past us. Or maybe we're approaching it. We're seeing oil prices continue to decline. So I think there's a lot of moving parts there, but any way you slice it, this should keep yields probably elevated for the time being. So we think short-term yields based on those rising expectations of a hike are probably going to remain, north of 4%. So if we look at that 2-year treasury yield, for example, and we think long-term treasury yields should probably hold in their recent ranges. So the 10-year treasury yield probably around 4.5% or so. Even though we might get some good news on the inflation front, there's plenty of factors that we think can keep it elevated. So even though we're seeing this shifting outlook, not much has changed in terms of what we're suggesting for our clients here at Schwab. We like a below benchmark average duration, short and intermediate term maturities, not too short because there's an opportunity cost there. If you're in very short term investments, you can actually earn slightly higher yields if you consider slightly longer maturities. But we acknowledge, now is probably not the time to go too long right now and long maturity or long duration investments. So that's what we're seeing in the bond market lately. Lots going on in the stock market, Lizanne. I know we talk about tech, it makes headlines, but what we have seen a relatively big sell-off in tech stocks, over the past week or so. So what's going on there?
Well, I've been thinking of it as the great chip dip I love me a chip dip, especially onion flavored, but a lot of carnage in the semiconductor stocks. The Philadelphia SOX index, which is the semiconductor index, down pretty much right at correction territory, which is generally defined as a drop of 10% on an intraday basis. And I think there are a number of factors that have come into play as opposed to some single specific catalyst. Some of it just has to do with positioning. It was an area that had gotten quite crowded across the spectrum of short-term trading institutions like systematic funds and the long-short hedge fund community and retail traders to some degree. So I think when positioning gets really, really crowded, sometimes you don't necessarily need one specific catalyst. But what the concern has started to morph into is about whether the capital spending associated with AI and the infrastructure build-out is starting to run into constraints, whether it's because corporations are starting to pull back or concern about them pulling back because the cost of continuing to invest at these levels without anything yet that is concrete in terms of ROI or return on investment. You've had concerns about the cost of inputs for this build out and whether that becomes kind of a binding constraint. So I think it's a whole host of issues, constraints on capacity, also some concerns. In fact, there was a recent announcement out of Microsoft that they might embed DeepSeek technology into their Copilot large language model. And we all probably remember the DeepSeek news of a year ago when it was seen as being disruptive to the US-based creators of large language models like Anthropic and OpenAI. And then lastly, I think I saw that a couple of key senior people from Google left. One went to Anthropic, one went to OpenAI. So that garnered. So it was like this confluence of things that I think caused some money to find its way out of what had been just unbelievable gains in that subsector of technology. And frankly, Colin, I think that backdrop is likely to persist here. We've talked about it a ton. I've written about it a ton, this rotational market that we're in, and that the real story that gets told by what the stock market is doing and the interconnectivity with what's going on in the AI world and capital spending and the economy more broadly gets told in a more full way under the surface of the cap-weighted indexes. So you really don't get a sense of what's happening and we do this only by audio, but I'm doing air quotes as you can see, but our listeners don't see, that what the indexes are doing is not a full description of what's happening to the market. And I think these rapid-fire rotations under the surface, even within segments like communication services or technology, just to cite two of the S&P 500 sectors, I think that kind of backdrop is going to persist, where you get these narrative changes. You get a piece of news that doesn't move the market in the aggregate, doesn't necessarily move any kind of needle in terms of the economy, but can really trigger some of these rapid fire rotations, especially among the very powerful cohorts within the market that tend to have fairly short time horizons. So I think that's the nature of the beast that is the stock market these days. And I don't think that changes anytime soon.
I think you say a lot, the stock market is not the economy and the economy is not the stock market. And so it sounds like chips and these sectors are not necessarily representative of the whole market. But I have a question though, because I kind of forgot about that DeepSeek moment. And given what you just said about, looking under the surface and how there are a lot of sectors in there, there's probably some headline risk with a lot of AI driven things.
Yes.
But what is the big risk with all, the spend concerns, chip concerns? I love the chip dip. I'm more of a hummus guy, but I like the chip dip. What does that mean if under the surface and broadly speaking, we're seeing strength elsewhere? So, how do you kind of tie that together?
You know what, Colin? I actually think there is a reflection there between what's happening in the market and what's happening in the economy. And that is that the economic cycle has been anything resembling cycles in the past. There's nothing linear about it. And that's really the post-pandemic era where we've had the roll through. We've had rolling recessions in certain segments of the economy. Arguably, we just came out of a manufacturing recession just 5 or 6 months ago at a time where the services side of the economy is actually starting to slow slow a bit. So we've had these rolling recessions, these rolling expansions hitting at a sectoral level and not in a coordinated way, bringing on a full aggregate recession. I think that's because what we haven't had is an accident in the financial system, credit getting overly tight. So some of those traditional triggers for an aggregate full across the economy recession just have not been in place. But we've had these sectoral periods of weakness and strength. And I think that's part of the reason why we have these sector rotations that are happening. And I think that how fierce they are and how short-term they are, that is very much driven by the cohorts that have become so dominant in terms of daily trading volume, which are the systematic funds and the commodity trading advisors, CTAs for short, in the long-short hedge fund community, and a very, very powerful cohort, which is the retail trader, somewhat distinct from individual investors. I think that's important to make that distinction.
So this week, Lizanne, you've got Keith McCullough on the podcast. I think that's going to be a really interesting interview.
Yeah, they always are with Keith. I've known him for a long time. Keith is the founder and CEO of Hedgeye Risk Management. Prior to founding Hedgeye, Keith worked as a hedge fund manager at the Carlyle Blue Wave Partners hedge fund, also at Magnetar Capital, Falcon Hedge Partners, and Dawson Herman Capital Management. It was in 2014 that Keith launched Hedgeye TV, and since then has not looked back. He is also the author of the popular book Diary of a Hedge Fund Manager, and also founder of private equity firm 77. And that's SCVEN, and then the number 7, which is kind of a cool name. And in addition to producing a wide array of macro research covering the top 50 global economies, Keith also hosts his own show, The Macro Show, as well as The Call at Hedgeye, which features the firm's entire 40-plus analyst research team discussing their favorite long and short stock ideas. Keith also hosts the acclaimed interview series Real Conversations, which features in-depth conversations with the world's top investors, strategists, and thinkers. I have done many of those with him, and they're really interesting conversations. Keith holds an economics degree from Yale University, and this is cool. While at Yale, he led the men's ice hockey team to a Division I Ivy League championship. All right, Keith, I am so happy to have you on the show again. Thank you for doing this. The first time you came on, it was a widely listened to episode, so we really appreciate it. So thanks for joining us again.
Well, thanks for having me on again. I appreciate it.
We've known each other a long time. I have sat in the hot seat with you grilling me on many an occasion, the various summits that you do. And it's always nice for me to switch roles and put you in the hot seat. So I want to start where I'm guessing we probably started last time we did this, especially for what I hope are even more listeners than we got the last episode that you joined us. But you work with what you call a quads framework. So maybe just share what that framework is, how you think about markets in that context, and then we'll take it from there and go in multiple different directions.
Yeah. So I think about the quads, just think of the weather, 4 different seasons, so 4 different quads. But the weather in terms of it being conditional factors that are occurring in that season. So the 2 factors that I'm modeling are GDP growth and headline inflation. So you have quad 1 is Goldilocks when you have inflation slowing and the economy accelerating. Quad 2 is a classic overheating of the economy when you have both growth and inflation accelerating at the same time. And when I'm talking about acceleration and decelerations, first of all, that's all I care about, the momentum of that. And secondly, I'm talking about that year-over-year growth or deceleration. Quad 3 is stagflation, so you have inflation accelerating and growth is slowing. And then quad 4 is kind of the death quad, where you have both growth and inflation slowing, and therefore corporate profits generally slow. So that's quad 4 is more typically where stock markets crash and the long end of the bond market becomes a bull market. So what we try to do is measure and map that and have the market signals, appropriately position us for whatever quad we're going towards, because of course the signal or the market is constantly front running the future economic outcome. And that's how we do it. Signal to quad, and we have all of our positions that are born out of each quad.
So you've built Hedgeye on the premise that process, and you've talked about your process, that it beats prediction. But Maybe let's start the conversation, still somewhat big picture. You've had a year where we've had geopolitical shocks, not least being the war in Iran and the shock that fed through to the energy markets. We've got a new Fed chair, Kevin Warsh, a regime change in fiscal policy, and it's all happening simultaneously. So I've been framing it as we're in a backdrop where unstable is maybe a better descriptor than uncertain. It's always uncertain, but there seems to be some instability here. So how do you work within your framework in an environment where there's so much instability and so many cross currents of that instability?
We generally move to monthly quads instead of quarterly quads. So quarterly being 3 months or more. Of course, as investors, we'd all prefer to be, holding something for 3 months to a year or across what we call the full investing cycle. But anytime you get, in this case, it's war on, peace on, back and forth. Like you said, shift at the Fed in terms of who's leading it. There's a lot going on. So what's happened, and I actually think that this fits with the current market structure, is that everything is happening faster. What's happening with market structure, as you know, is completely different than, Trump's decision to engage in war. So when you put those things together, you get these, in fractal speak, you get these exponential functions in markets where, you have jump conditions and things, happen faster and faster, so both the breakouts and the breakdowns. So we've had, relative success as the pace of the game picks up. And, I often say, if you can't play fast, then you can't play the game. You got to be able to borrow one from Kahneman and Tversky. You have to be able to play fast and slow. And I think this year has been a classic example of having a process that allows you to play a little faster.
And more movements this year among the quads. So talk about where you see us sitting right now and what maybe the pattern and direction that has been, the last year to date, whatever recent time frame you want to talk about that shift from quad to quad.
Yeah, I think it's been on that, like just staying on the right side of it. So if you think of the quads the way that they are, quad 2 and quad 3 have one thing in common. Inflation's accelerating. Okay. So that was very clear to us, starting in December, never mind when the war kicked things into higher gear. So we were actually positioned for inflation to accelerate in the first half of the year alongside growth. So we call that quad 2. We still have a 3 handle on GDP for Q2. So the growth piece, irrespective of what people politically or otherwise felt, thought, or dreamed, the fact of the matter is that economic growth accelerated. So, the first half of the year, and it's never always this simple, but simplifying the complex, you get inflation accelerating in the first half of the year. And now we think that inflation is going to quad 4 or quad 1 or to the left side of the 4 quadrants. So you can have disinflation in a bad way, which is quad 4, or you can have Goldilocks, which is currently what the market's still saying it's good with, which is disinflation in a good way, which is growth accelerating. I actually think the biggest, I don't make calls. Like, thank you for saying that. It's not about prediction. It's about process. I'm just executing on the process. If people are looking for me to make a big call, that's kind of old wall, as I like to call it. But if you're just executing on what the highest probability outcome is, one, you'd say inflation peaked in the month of May at 4.25%. It's going to decelerate for the next, really 9 to 12 months from here, which would mean that the peak for that inflation cycle and bond yields are in, which is a pretty important call for asset allocators to understand, and all of the equity factors, rate sensitivity in particular, that are born out of it. So my portfolio today looks drastically different than what it did, in December, because I'm positioned for disinflation as opposed to inflation.
Now, what's the basis for that view that the peak was in May? Because I don't think that's really the consensus. I think the consensus is for some sort of further acceleration, whether it's the lagged effect of what's already happened, war-related or not, the near-term AI component of inflation. So talk about what you're seeing in your data that puts you in that disinflationary camp.
Yeah, if you put the first half of the year in context, if GDP is accelerating, demand's accelerating, and you cut off supply, then you're going to have a rip in the primary factor that derives inflation, which is the price of oil. So that's the heaviest weight in our model. So again, I'm simplifying a lot of modeling and the complex, but I think most human beings can understand that. Then the economy is slowing in the back half of the year. Therefore, demand is slowing and you're opening supply back up. So, that's a decel or a deceleration. From a base effect or a modeling perspective, which you and I can geek out on, but I don't think most people will, find that all that interesting. But I would say it's the base effect stupid in the sense that just think of by this time next year in the first quarter, when you're comparing against $113, $115 oil price, and the oil price is currently trading at 70 or 80, even if it was at 90, it would still be a deceleration in that primary input of inflation. So we have a daily, weekly, and monthly nowcast for headline inflation that's extremely accurate. And that's what really leads us, to that. I wouldn't believe that unless the model was telling me that. And I do quite like, to your point, that the Fed is going to be the last one to figure that out, because the Fed's essentially going to be too hawkish for too long, and then they're going to have to panic dovish, as they generally do when you get quad 4 or disinflation and growth slowing conditions. Again, I think that starts to manifest into the back part of the year into 2027.
Let me pull on that thread a little bit, given the recent Fed meeting and what we now all know about what Kevin Warsh is going to try to do anyway with the creation of these task forces and really implement a kind of regime change in terms of everything from how the Fed communicates, to the use of press conferences, to how vocal he sees everybody being, to whether there's ultimately going to continue to be a dots plot or summary of economic projections. Because I remember you describing when we sort of entered into this Strait of Hormuz problem, you described it as an inflationary impulse that the Fed cannot look through. So what are your thoughts on how the Fed under its new leadership is going to navigate this beyond what you just said? It's a tendency for the Fed to sort of act hawkishly first. Do you think that's his sort of guidelight, given he wants to probably establish some hawkish credentials in the face of higher inflation? And then what would it just be, the growth slowdown that you anticipate that would trigger then a move back to a less hawkish stance? Like, do you think the Fed's going to make a mistake here?
Yeah, I think they're already making one. I mean, I do appreciate that he's going to change some things. I don't know how. It's like firing a bad coach. I mean, Powell never thought that inflation would get back to 4%, never mind above 4%. Therefore they were behind the curve on how high inflation could go. We can go through this multiple times back in 2022 in particular, where inflation continued to double and they thought that it was transitory. I think most people who are alive with a pulse and hopefully an internet connection understand how inaccurate the Fed can be in terms of their projections. So, I don't worship at the altar of their dot plots, and I don't front run, the Fed in as much as I fade the Fed quite a bit. Like, I think it's really important to understand that the bond market front runs the Fed almost all of the time. And that's should be a real humbling point of analysis that I hope they incorporate. If they do have, market signals as the point of contact that Powell or certainly Yellen would never touch, they come up with these academic type linear Gaussian assumptions that don't work. It's good for me. It's like a perverse thing to say, but it's not great for the people. The American people are funding this. I don't think it's good for the people to have an inaccurate government body, but I do think that it's good for the rest of us who are trying to do the opposite of the mistake that they're making when they're making it.
Now, you mentioned the bond market. Let's hop on a plane and go overseas a little bit, because I've seen some comments recently about, the foreign yields, gilt yields in particular, the Japan 10-year hitting cycle highs simultaneously. And I think I saw that you called that a regime signal, not a data point. So talk a little bit about your thoughts on some of the synchronization in terms of global bond pressures and how to think about it in the context of U.S. markets.
Yeah, the key to the quads is also modeling them globally. Like, I still find it somewhat interesting, if not entertaining, that people have views on global growth and inflation without models, never mind AI-driven models and data-driven models. Yeah, our models are becoming more accurate because AI is really getting to the answer of the market's question on what the economic data is actually reading on a trending basis. So I think that's great. What the synchronization, if you will, of the peak in bond yields really reflected a synchronized peak in what we call global quad 2. Global quad 2 is over. now we're going into a global slowdown in the back half of the year. And that's why, actually, if you just run down the line on the three big ones that matter in my model, the UK 10-year gilt yield, the German 10-year yield, and the Japanese 10-year yield, they've all put in cycle peaks and have started to break down on either a trend or trend basis. Like the UK, the guy just got canned, and the prime minister of the UK wasn't a shock to anybody that lives there.
Because that's what they do every year or so.
But they had the worst thing for human beings, which was quad 3. Right? Stagflation.
Yeah.
If you have quad 2, you can have a party like we're attempting to have with SpaceX and everything else here in America. But if you're in any other country that doesn't have that, you're stuck with like eating it. And, we're super bullish on the dollar. So the rest of the world already has stagflation, because they have weakening currencies. So again, the purchasing power of people goes down. You understand that most economists don't teach it that way, but just think about it. I mean, you earn a currency and it goes down. The purchasing power goes down. So the UK, all of Europe, we actually think the chance of Germany, re-entering a recession is rising in the back half of the year, not like next year. So we have a global slowdown that's led by, the western side of Europe, and the US eventually starting to slow as well. So that's why I think it's not just US bond yields are done going up, but global bond yields are done going up.
You mentioned SpaceX, and I'm not going to ask you to do a deep dive on the company, but I want to ask about it in the context of something that we've talked about before, and I know you often do, which is the whole notion of supply demand, and a lot more supply coming via some of these mega IPOs at a time when the CapEx demands for a lot of companies suggests you might see some compression in stock buybacks. So putting those sort of two pieces together, what does it tell you about maybe the nearer term landscape with lots of new supply coming and maybe some compression on demand via fewer buybacks?
Yeah, thank you for not asking me for my thoughts on colonizing Mars and what multiple you can put on that. I mean, I think Elon, I've always called it the mother of all bubbles, or hashtag Moab, on Twitter, I always call it that. That really peaked in 2021. I think this year has actually been very interesting because so many people that have never called the stock market top or crash or bubble or all the above are experts in how this market's overvalued. Meanwhile, they're bag holding all these bubbles that have already popped and dropped, right? I mean, there's a legit case to make that the real oversupply is going to be in the market cap of the heaviest components of the broadest indices. So I think that really, when I look at it, it's not just SpaceX, it's Marvell. Marvell is going to be the second largest addition to the S&P in its history, which is a long history, next to Tesla. If you recall that, obviously, you'll recall this, but that had a huge impact. So just think of it NVIDIA's got a 9% weight. You go down the line, NVIDIA's got the top. I mean, these new issues are going to take away from the heavy weights that are a bubble in and of themselves. There's no history to say that wasn't a bubble, just the absolute, market cap and percentage of the index. So I think that as somebody who understands all that, and all the factors embedded therein, I think that's probably the big reason why, despite the market, the Russell 2000 hit an all-time high yesterday, and has double the performance of the S&P on a year-to-date basis. Yeah, and it should. And when you're in a quad 1 and 2, the month of June we have as a quad 1. I don't want to confuse people with all these things. I think that people will just get confused because I use my own language, and I definitely didn't learn what trades, trends, and tails and quads are at Yale University. I can assure you that. So I don't want them to get lost in that. I think it's very straightforward if you understand the math and what actually happened. But, in quad 1 in particular, small caps, which is Goldilocks, as a reminder. Right. They love that. So you get a broadening of the rally. You get, small caps, large caps, value, everything that, and you and I can go back and forth on what those definitions actually mean. But, really, I think the point is that from here going forward, if you're going to bring, Anthropic, you're going to bring these competitors to mega cap. That's the real supply problem I see from a market perspective that's already in motion. We call them the bag 7, not the mag 7. I mean, I think that's the real oversupply problem. That's one of the that and market structure, which go together. I think that the whole thing, that's where I understand where people have been wrongly bearish all of this year, but it doesn't mean it's not going to be bearish. The key question, as you know, is when is it going to be bearish? And I think we're finally knocking on that door post the SpaceX IPO.
Yeah, I'm glad you brought that up because the Mag 7, which is still the, oh so popular cohort to talk about, even though it's becoming, the Lag 7. For a long time, those 7 stocks were both good price performers and big contributors to index gains. Now even the latter has faded. So the best performer of the Mag 7, which I think is Alphabet, is not even in the top 100 best price performers within the S&P. NVIDIA is still the largest contributor to S&P returns of the Mag 7, but it's the 10th largest contributor. So there are bigger contributors, 9 of them, than even the biggest contributor of the Mag 7, and it's not even in the top 100 in terms of price performance. So let me then rewind again back to your broadening view. So you've got Russell 2000, 2x the performance of the S&P this year. You've got equal weight, kind of in line with the S&P. So do you see that? I'm not going to say secular. That's way too long a time period, but you still see this as having legs, this broadening out. And is the basis for that? Because I think I've read that you have a pretty optimistic view on the earnings growth trajectory of kind of the rest relative to, say, a top 10 or Mag 7 or Lag 7 cohort, whatever subset you want to talk about.
Yeah, I've had, because this goes back, 9 months now, where we were calling out that earnings are going to smoke expectations. It's going to be the biggest rate of change acceleration in S&P earnings of our time. That's all happened. That's what's giving birth to the bubble IPO that is SpaceX. Because people will believe what they want and need to believe. It doesn't have to be true. But the fact of the matter is that GDP did get back to north of 3%. Inflation was additive to earnings. Most people don't know that for some reason, but a lot of cyclical companies quite like having pricing and margin expansion, and that's what happened. So I think that the best of the earnings acceleration, like our case on that, like back in the fourth quarter, that the first half of 2026 would be just that. And that's pre-war, with war, without war. That happened. So I think that by next year, that's going to be the most bearish thing I can tell you, is just to remind you that you have to cycle against 40, 50% earnings growth. You could easily see S&P earnings growth go to 0 on that. So there's yes, the broadening. I do think the broadening for me right now, my biggest broadening position that I've put on, and only in recent weeks, is putting on rate sensitive equities that have lagged. Right? Because, if you have a view that inflation and interest rates are going up, which was our view up until a month ago, then you're going to be short housing, short REITs, short low beta factor exposures like sectors like healthcare. Those were basically all my shorts. Now they're becoming my longs. So that really, gets you back into, and I don't know if there's a sector that people, we run a big institutional business. We have a lot of, similar subscribers that you do in the mass market, RIAs, family offices. I don't think that there's a sector that is more hated than housing, or underowned for that matter. It's not a huge component of the S&P, but those are examples of the next broadening, if you will. Because I think that the broadening that we already had was pretty easy to call. This one's going to be more specific.
All right. What other faves from a broader asset class perspective based on your process? What else do you think looks interesting here?
I mean, I think you still have to stay with secular growth until non-Bag 7, that's with a B. Literally, because Google broke trend on our signal in the last week. We only have Apple left, but we've owned multiple kind of what we would call secular growth, like nanotechnology, quantum computing. I'm going to stay with that until they stop working. And I know what I'm doing. I know what I'm dealing with this, which is I'm holding a grenade, but I like blending. I love to have asymmetry. I have a max level of 30 different ETFs that I currently own. I've gotten it down to 22. So I've raised cash. One of the big lessons of all the things I've screwed up, Lizanne, which, is manifest, is that I get out of my winners too early. I've been doing this for almost 30 years. And if I go back,
no one ever went broke taking a profit, Keith.
Right. But when I look at these things in this environment, I guess I'm getting less bad at this. I just ride winners for longer, and I let my signal tell me when to get out.
All right. One last question, somewhat bigger picture. You talked about some of the lessons you've learned and maybe letting your winners ride a little bit longer, but you've always been vocal about the behavioral challenges of investing. And that's something that, I have focused on for my 40 years doing this. And that relates to at times the attachment that investors get to some sort of thesis, some sort of narrative, even when signals, your quad signals, other signals are changing. So what's the best piece of advice around that you can give to our listeners?
I think we've given birth to like a whole new cattle class of post-pandemic investors, that will say things that you wouldn't hold the test of time, never mind one cycle. Like you should invest where you see excitement or you have a passion or you have like these types of words that Elon Musk would use. Been there, done that, screwed that up more so than most people listening to this call could, but I won't this time. I just think that like you should really check the emotional quotient at the door and you should be rules based. They're just tickers. They're not marriages. I think that that's actually going to be, if there is like, in the fourth turning, as my partner Neil Howe will call it, a generational event for the baby boom investing class and the learnings for the younger people, a lot younger than us. It's don't do that. I think that that's coming, and there are plenty of educational components of the script that have already been written, and my hope is that people invest dispassionately, using math and modern, again, you got modern day AI. It understands fractal math instead of people saying, well, I don't understand that. Well, it's too bad, but the machine understands.
Yeah, the machine does.
Yeah.
Well, a clinic, as always. Thank you, Keith. Always enjoy our conversations, especially when I get to be the one asking the questions. So thanks for imparting your wisdom to our crowd here.
Thanks for having me on. Always good to talk to you.
So, Lizanne, let's look ahead to next week. We have another short week thanks to the July 4th holiday. Are there any fireworks on your radar, either, personally from a party or barbecue standpoint or in the, potential economic data?
Well, always fireworks, the real kind on 4th of July. That's always a highlight. That it doesn't get old, no matter how old I get. So that'll be on the docket. And it is a holiday shortened week, obviously. So there'll be a little bit less in terms of data coming out. We'll get consumer confidence from the Conference Board. One thing I wanted to remind listeners, and we've mentioned this before, but I hope we're always getting new listeners, is that measure is very similar to University of Michigan's version, which they call consumer sentiment. But those have diverged quite a bit, with consumer sentiment at a record low and consumer confidence, and it's been a bit more resilient. See whether that continues. But the reason for it is that the nature of the questions that are asked tends to gear consumer sentiment more toward what's going on in the inflation environment, whereas consumer confidence, based on the questions, the labor market and conditions therein tend to influence the answers there. So that helps to explain why there's been a bit of a divergence. We get the job opening and labor turnover survey, JOLTS for short. Lots of interesting data in there, including obviously job openings. That's in the label, but also the quits rate and the layoffs rate. Only caveat with that data, or at least as a reminder, is it lags all other jobs-related data that we're used to getting by a month. So keep that in mind. And then on Thursday, normally we have Jobs Friday, but Friday is the holiday and the market is closed. So we get the labor market report on Thursday. So that will be in sharp focus, as it always is, especially in a backdrop, as we already discussed, of the Fed maybe shifting toward more of a tightening bias. How about you? What's on your radar?
The labor market. So you hit on the main points there, but I think the Thursday non-farm payrolls report and unemployment rate reports are going to be very important, I think, to see if the strength we've seen over the past 3 months is sustainable and if it's real. Because if we go back to last week's Fed meeting and the statement, it seems clear that the focus is on inflation as opposed to the labor market right now, probably because the labor market's doing pretty well. I do wonder if we see a reversal, not that we're necessarily expecting that, but if we see that the recent strength turn into maybe slower job growth, something like that, is that something that the Fed might be paying attention to, or will it still just be all inflation? So that's going to be very important. And then we also get the ISM manufacturing report, the Institute for Supply Management. We don't get the services one just yet. We get that the following week. But you alluded to this before, Lizanne, kind of a little manufacturing pickup over the past few months. We've seen improvement in that index. And it's not just the headline that we're going to be looking at. We also like to look at prices paid. That can be very important to see what these purchasing managers are thinking from the prices that they're paying and if they'll be passing them along. And then, of course, the employment sub-indexes. So a little bit mixture of the hard data and the soft data. So even though it's a holiday shortened week, we have a lot of, big economic releases that are going to be pretty important. Let me turn it back to you real quickly, Lizanne, because just on more of a personal note, we this week we lost the former chair of the Federal Reserve, Alan Greenspan, who passed away at the age of 100 years old. I know that you have crossed paths with him over the years. So, any interesting thoughts or insights there?
Yeah, I think the first time I met Greenspan was in the late 1990s. He used to be a guest from time to time on the late great show, Wall Street Week with Louis Rukeyser, and I became a regular panelist on that show in 1997. So that was the first time. I served on President George W. Bush's bipartisan tax reform commission in 2005, met him, I think, twice during the span of that commission. And then I had the pleasure of interviewing Greenspan a couple of times, once at Schwab's Impact Conference in front of a small little audience of about 5,000 people. And what I always took away was his brilliance, unbelievably smart man, photographic memory. He has been lauded as the maestro, but he's also received a lot of criticism. And what I found kind of compelling about his views on both of those is he would sometimes push back on the criticism he got. And a lot of that came around the housing bubble bursting and why the Fed hadn't done more with their regulatory tools that they had, macroprudential tools. And he pushed back a little bit on that. It's just saying it's hard to see a bubble before it ultimately pops. It's almost better to, clean up afterwards. But he also pushed back on a lot of the credit he was given. So it wasn't just, I didn't do anything wrong. Let's just praise me for the things that I got right. He was humble enough to say, I probably didn't deserve all the blame that I got, but I definitely didn't deserve all the credit that I got. So I think that humbleness was resonant with me. That's it for us this week. Thanks as always for listening, everybody. As a reminder, you can keep up with us in real time on social media. I'm at Lizanne Saunders on X and LinkedIn. The imposter problem has gotten really bad again. I'm not sure what accounts for that, but make sure you're following the real me.
And I'm at Colin Martin CS on X and LinkedIn. That's Colin with 2 L's, and the CS is for Charles Schwab. And you can always find all of our written reports, including lots of charts and graphs at schwab.com/learn.
And if you've enjoyed the show, we certainly hope that you do, please consider leaving us a review on Apple Podcasts, a rating on Spotify, or feedback wherever you listen. And please tell a friend or more about the show. Slight break from us next week because of the holiday, and we will be back with a new episode in 2 weeks.
For important disclosures, see the show notes or visit schwab.com/oninvesting, where you can also find the transcript.